In this video, you are going to learn 3 structured scalping strategies that combine higher time frame bias, liquidity engineering, and precise lower time frame execution. You will see how to define direction using daily bias, how to recognize inducement before the real move begins, and how to use fair value gaps and liquidity grabs to enter with accuracy instead of guesswork. Welcome to the ComLucro channel. In this session, we bring these elements together inside one unified framework, so you can understand not just where to enter, but why the move happens in the first place. The goal is simple: align your scalping decisions with institutional behavior and execute with clarity, structure, and confidence. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Now, let's begin with the first scalping strategy. We use the 30-minute and 5-minute charts. On the higher time frame, we define direction through market structure, identifying break of structure and change of character, then mark fair value gaps as entry zones. Once price returns to those areas, we move to the lower time frame. On the 5-minute chart, we wait for confirmation, typically a liquidity grab, before entering and setting targets. This approach aligns with the trend and uses precise lower time frame timing. Now, let me show you how this works directly on the price chart. In the first step, we identify the market direction by marking breakouts and changes of character, or BOS and CHOCH. These can easily be drawn manually using simple trend lines and labels to visualize structure shifts on the chart. Start by marking each break of structure that confirms trend continuation and each change of character that signals a possible reversal. These 2 elements form the foundation of market structure analysis. In this example, we can see the price breaking structures to the upside on the 30-minute chart. That means we're in an uptrend and should focus only on buying opportunities. But structure alone is not enough. Before dropping to the lower time frame for entries, we need to confirm that this directional bias is also supported by higher time frame behavior. And that is where daily bias becomes critical. Let us start with the bullish daily bias. First, we mark the high and low of the previous day. If, on the following day, price breaks above the previous day's high and closes above it, this immediately establishes a bullish bias for the next day. Another bullish scenario occurs when price attempts to move below the previous day's low but fails to close beneath it. Even though the low is briefly taken, the inability to close lower signals a lack of selling pressure. In both situations, we can reasonably expect the next day to be bullish, or at least for the previous high to be reached. The bearish daily bias follows the same logic, but in the opposite direction. If price breaks below the previous day's low and closes below it, we have a bearish bias for the next day. Similarly, if price attempts to break above the previous day's high but fails to close higher, this also produces a bearish bias. In these cases, we can expect the next day to be bearish or at least to revisit the previous day's low. As with most trading concepts, daily bias becomes much clearer when applied to real price action. Once that directional expectation is defined, the next step is not to trade blindly, but to look for precise execution zones that align with that bias. Next, let's talk about fair value gaps. These are imbalances on the chart, zones where price moved so quickly that it left a gap between candles, creating an area of inefficiency. The market often returns to fill these gaps as it seeks balance. We'll use these manually marked gaps as key zones of interest, expecting possible price reactions when price revisits them. However, price does not always react immediately when it reaches a fair value gap. Before the real move begins, liquidity must first be engineered. That is where inducement comes into play. Liquidity-based inducement is the most common form of inducement you will see in the market. This is when price intentionally creates a new high, a new low, or a small order block or breaker that looks too clean, with the sole purpose of trapping traders, collecting their liquidity, and then delivering the real move. And this happens every single day, on every market, and on every time frame. The main objective behind this behavior is to generate stop losses that smart money can use as fuel. By pulling retail traders into the wrong side of the market, their stops can be collected right before the true move begins. That is why you constantly see a tiny high before price drops, a tiny low before price rallies, a fake breakout before a reversal, or equal highs and lows getting swept by 1 or 2 pips. These are not coincidences. This is smart money deliberately engineering liquidity. With that in mind, let's go deeper and look at real price chart scenarios. Here we have a trading setup where price taps into a very strong daily demand zone and reverses, forming a valid change of character. Naturally, we expect price to pull back into the bullish fair value gap, sitting in the discount area, which is where we want to look for buys. However, before price fully taps into the 1-hour fair value gap, something important happens. Price pushes lower, reacts briefly near the fair value gap, and then immediately reverses, forming a new lower low. This new micro low is pure inducement, and this is exactly where many traders get trapped. That minor low convinces premature buyers that price has already mitigated the 1-hour fair value gap, and that the reversal is already underway. Because of fear of missing the move, they enter too early and place their stop loss right below that micro low, creating a clean pool of sell-side liquidity. This is precisely what smart money is looking for. Smart money uses this inducement to trigger early buyers, build liquidity below price, make the market appear weak, and trap retail traders who place sell stops under the micro low. All of those stops become the liquidity institutions need to fuel the real bullish move. Once enough liquidity is available, price dips slightly lower, sweeps the inducement low, collects those stops, and finally mitigates the true fair value gap, the one institutions were targeting from the very beginning. At this stage, liquidity has been collected. The imbalance is filled, and the true institutional point of interest inside the fair value gap has now been mitigated. However, inducement does not always appear as clean or as simple as the previous scenario. In some cases, instead of forming a small micro low, price creates a fake change of character on its way down and builds equal lows just above a tiny, very clean order block. At this point, 3 components are working together. A fake bullish CHOCH, equal lows which build a strong liquidity pool filled with retail stop losses, and a fresh, very small order block that formed inside the CHOCH leg. This tiny order block is not a real point of interest. It exists purely as an inducement. Its only purpose is to lure traders in early and attract even more premature sellers before price reaches the major true point of interest below. Smart money uses this small order block to generate additional stop losses beneath it, increase available liquidity to fuel the real move, and encourage retail traders to enter early based on a false signal. Now, you might wonder why price needs to form an inducement right before tapping into the fair value gap. The reason is simple. If price moves directly into an FVG with no inducement, there is no liquidity. Smart money has no fuel to reverse the market. The reaction out of the FVG becomes weak, and the entire setup can fail due to a lack of sellers to buy from. In simple terms, inducement is what creates the liquidity that fuels the move out of the fair value gap. Once that liquidity has been engineered and collected, we return to our execution model and focus on precise timing. First, wait for the price to trade back into the gap, then move to the lower time frame to look for confirmation signals before entering a buy position. So, let's switch to the 5-minute chart. On this lower time frame, the goal is to spot signs of a possible reversal. One strong clue is a bullish liquidity grab, when price briefly wicks below a previous swing low before reversing upward. This move shows where stop losses were triggered, followed by a sharp reaction in the opposite direction. Liquidity grabs often occur near key zones like fair value gaps and can serve as powerful entry confirmations. When this move also breaks a recent bearish structure on the lower time frame, it gives us extra confirmation. In other words, it forms a change of character. Now it's time to execute the trade. Place your stop loss just below the low of the liquidity grab and set your target at the next key level identified on the higher time frame. In a bearish setup, start on the higher time frame by confirming a clear downtrend marked by lower lows and lower highs. Then, manually outline the fair value gaps as potential supply zones. When price retraces into one of these areas, move to the lower time frame and look for a bearish liquidity grab just above a recent swing high. Enter the trade once confirmation appears. Set your stop loss above the liquidity grab and aim for the next major support level below. Finally, always apply solid risk management to protect your capital. Stick to your plan and stay disciplined, avoiding emotional decisions. This strategy performs best in trending conditions, not in sideways or choppy markets. Keep learning and reviewing your trades to keep improving over time. Let's move on to the second scalping strategy. This setup has three main parts: a draw on liquidity, a liquidity grab, and the entry. So, what is a draw on liquidity? It simply means identifying a key liquidity level that price is moving toward. In other words, the market often moves toward areas with resting liquidity, such as equal highs, equal lows, or sharp reversal points, because that's where many orders are waiting to be filled. You can mark these levels manually by drawing lines across equal highs and equal lows, or by highlighting clear buy-side and sell-side liquidity zones on your chart. With that in mind, the first step is to locate a major high or low on the 30-minute chart that price is approaching. In this example, we have buy-side liquidity on the 30-minute chart, and price is being drawn upward toward it. We can anticipate that move, since liquidity tends to attract price. If a clear draw on liquidity isn't visible on the 30-minute chart, zoom into the 15-minute chart for more detail. Next, we look for a liquidity grab in the opposite direction of our draw on liquidity, this time on the 5-minute chart. So let's switch to the lower time frame. Keep in mind that in this case, the buy-side liquidity sits above us. At this point, we're looking for a swing low to be taken out, a sign that price may continue moving upward. You can enter the trade as soon as price returns inside that range. Alternatively, a more conservative approach is to wait for confirmation. Let price push higher to confirm the reversal. Then identify a manually marked fair value gap to set a buy limit. If no clear gap appears on the 5-minute chart, zoom into the 1-minute chart for greater precision. Let's quickly recap the bearish setup. In a bearish scenario, start by identifying a major liquidity area that price is moving toward, such as a previous low or a level packed with stop losses. These zones often attract price before a reversal occurs. Then, switch to the 5-minute chart and watch for price to move above a recent swing high before snapping back down. This action shows a liquidity grab, suggesting the market may start trending lower. Next, open a short position and place your stop loss above the high of the liquidity grab. Allow price enough room to move. Avoid keeping your stop too tight. For your target, aim for the next clear sell-side liquidity level. This keeps your trade structured and intentional. Now let's move on to the final scalping strategy, one that's completely based on pure price action. This method uses just a single time frame, and you can choose whichever best fits your trading style. First, identify the market direction to decide whether you're looking to buy or sell. Trading in the same direction as the dominant trend increases both confidence and consistency. What we want to see here is a clear trending environment. In an uptrend, price should form higher highs and higher lows while respecting the previous swing lows. In a downtrend, it should create lower lows and lower highs while respecting the swing highs. In the case of an uptrend, wait for price to form equal highs and then break above them. From basic price action principles, we know that when price revisits this breakout zone, previous supply turns into demand, meaning there's a stronger chance for price to bounce back upward. So we wait for a pullback into that zone and then look for confirmation before entering a trade. You can enter once a candle closes above the previous candle's high. That's your signal that the level is being respected. If there's no confirmation and price keeps falling, simply skip the setup. You can also zoom into a lower time frame to refine your entry. After price returns to your demand zone, switch to the lower time frame. You'll often notice a short-term bearish correction, which represents the pullback from the higher time frame. Draw a trend line across the wicks with the most touches and wait for price to break above it. Once that breakout occurs, you can open a long position. Place your stop loss below the swing low and set your first target at the swing high. This confirms that the short-term downtrend has ended and price is ready to continue upward, following the main bullish trend. Now let's look at the bearish version of this setup. In this case, the higher time frame shows a clear downtrend, with price consistently forming lower lows and lower highs. What we're looking for is an equal low followed by a clean breakout to the downside. When price pulls back to this breakout area, the previous demand zone now acts as supply, meaning there's a stronger chance that price will reject this level. For confirmation, wait for a candle to close below the previous candle's low. That's your signal that sellers remain in control and it's time to consider a short position. If that confirmation doesn't appear and price keeps rising, simply skip the trade and wait for the next setup. For a more precise entry, zoom into the 5-minute chart. You should see a small bullish correction, a short-term uptrend against the main downtrend. Draw a trend line across the lows of this move and wait for a break below it. Once it breaks, you can enter a short position, place your stop loss above the recent swing high, and set your first target at the previous swing low. This setup shows that the short-term pullback has ended and the price is ready to continue downward with the overall bearish trend. Keep in mind that you can always check the higher time frame to see where the price is positioned in the bigger picture and whether your analysis aligns with it. For example, if there's a key market structure level right in front of the price, there's a higher chance that the setup will fail. That's because when the price reaches this level, it's likely to get rejected by the market. So always check the higher time frame to make sure there's enough room for price to move in your direction before reaching the next key level. That simple habit keeps you aligned with the broader market flow and helps you avoid trades that run straight into major structure. Together, these 3 scalping strategies create a structured framework built on daily bias, inducement, and precise execution. Whether you trade ICT concepts or pure price action, the real edge comes from consistency, following your plan, managing risk with discipline, and executing with clarity. Over time, that consistency is what transforms a setup into true trading skill. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.